So next we have Axel, and Axel is joining us from Palo Alto. He's the president and chief investment officer of Merk Funds, and they run several innovative currency funds, and they've had a couple new ones recently, and I'm sure he'd be happy to talk about those at some point. But Axel is, I think, one of the clearest voices on currencies and talking about sort of what drives relative value in currencies and how that that kind of fits into the global economy. So we'll let him take over from here. Axel, there you go.
Right, thanks. And it's great to be here. And I already took some notes. I think if we have a few days, I can go through all of my thoughts that came to my mind as you guys had great questions already. Before I dive into too many things, and by the way, I'm not going to give you the latest carry trade strategy, so don't worry about that. What I'm going to talk about mostly is the primary driver of the world of currencies, the dollar, and put that into the context, clear up a bunch of myths out there, but most notably where we're heading in a global context. And the one thing I think that maybe got missing a little bit in the introduction is that we complain a lot about what policymakers do and make, but what really matters is, well, what are we going to do about it? What are you going to do about it? And so similarly, I'm going to talk a little bit about emerging markets, and they, for all the right reasons, are complaining, but different emerging markets have reacted differently to what the Fed has done, and there are different investment implications. And I think, Chris, you picked up on what Bill Gross at PIMCO wrote just about. Yesterday he published a thing that interest rates may stay low for a very long period. And the question also was related to that. I agree that that's possible, but what Bill Gross didn't write is that I think that's going to result in a highly unstable environment, and I'll go into the reasons of why we think that's going to happen. I'll also talk a little bit about Ukraine. Maybe I'll start with Ukraine just a little bit, because I see Ukraine a little bit differently from most people. I think it's just a symptom of the world that we live in. And the reason I say that is if you take a big step back, there are two consistent themes here that we have. We have a world that has too much debt, and we have real wages that haven't really been going anywhere in the developed world. And we can talk about the reasons, but we only have half an hour here. But what happens when, for an extended period, real wages don't go anywhere? People are unhappy. And that means they vote for more populist politicians. That's why we have the rise of the Tea Party and the Occupy Wall Street movement in the US. That's why we have revolutions in the Middle East. That's why we have a populist prime minister in Japan. And that is why in Ukraine, it doesn't matter whether they are associated with the West or the East. They can't balance their books. And so that creates tensions. The one thing policymakers throughout the world have in common is they never blame themselves. They blame the wealthy, they blame the foreigners, they blame a minority social group. And so the common thread here is that political stability is on the decline. And in the US, we can solve the issues, entitlement issues, with a grand bargain, but it's unlikely to happen when we have an increased polarization, and that trend is going to continue, at least in my view. Now, there's one thing that works, that gets policymakers to act. We saw that in the Eurozone. It's the pressure of the bond market. If the bond market imposes reform, they'll do it. Now, the difference between the Eurozone and the US, though, is in the US we have a current account deficit. So if the bond market ever tells policymakers in the US to get their act together, the dollar is far more vulnerable than the dollar has ever been. So I have a bunch of slides here. I'll go through them fairly quickly in the interest of time. And but the first thing I wanted to show that investing in the bond market since the late 70s has been a great deal. You cannot ever possibly lose money, just like in the stock market. Always goes up, right? Well, there were some jitters. We just had a tiny decline here in 2013. Year to date, by the way, the bond market is up again. And so people have been blinded into reasonably good returns, but there is a fear out there that bond price is going to go down, and I think that fear is shared by many here. The question is, oh yeah, and by the way, Heather, she's with my office, she's handing around a sheet, and I'll talk about that in a few minutes a little bit. It talks about the relative printing presses throughout the world, and so put that on your desk, and then when we get to it, I'd like you to have a closer look at that. So we've had this little bit of a decline here, and the question is what's going to happen going forward? What are portfolio implications? Because typically, assume that you don't have some of the views that are expressed here. You're just a traditional investment advisor, you make a traditional investment allocation to stocks and bonds. Well, stocks have gone up. You would want to reallocate some of that money into bonds. But what about if you have a negative view on bonds? Where the hell do you put your money? And so you don't have to think that the world is coming to an end to say that, well, maybe I got to be a little bit more creative, or maybe think out of the box. So I'm going to talk about that a little bit. And the reason you want to think about that as well is because ultimately you want to put yourself into the shoes of other investors and other policymakers, because that's how you can best then decide of how these dynamics might be playing out. So year to date, just as a sign, commodities and gold have been leading the way. That's as of a few days ago, April 22nd. That's many people said, oh my God, commodities boom is over, gold boom is over. Well, year to date, it's at least bounced back a little bit. The one thing I want to point out on the right-hand side, the dollar is down year to date. I don't know whether many people know that 2 years ago, in the height of the Eurozone crisis, the euro beat the dollar. On January 1st, I was mentioned in a page A1 article in the Wall Street Journal praising me for my brave call on the euro. I had said in the beginning of 2013 the euro is going to be the best performing major currency, and I was the only one sticking out my neck. So last year the euro beat the dollar as well, and this year the dollar is down. Now, in defense to anybody out there, nobody in their right mind would ever say the euro is going to be the best performing currency, and not because of the issues in the Eurozone, but because the euro is much less volatile than other currencies. And so if the euro ever had a rebound, and it did have one, well, other currencies, higher beta currencies, more volatile currencies should have outperformed it. The reason why the euro outperformed anyway is because, of course, a lot of money had fled the Eurozone. And one of the things that had happened in the summer of 2012, this was when Draghi gave his speech, he'll do whatever it takes. We had 2 years of this risk-on, risk-off pendulum. It was, you didn't have to think. You just risk is on, you buy these things, and then you sell these things, and you chase into the dollar and whatnot. Well, all the quote-unquote risk-on things, they were expensive. And then Draghi came in, and you may agree or disagree with what he did, but after he promised he'll do whatever it takes, the euro was less risky than it was before. And suddenly you have an asset that was cheap, maybe for all the right reasons, but it was less risky than before. And sure enough, when money went into risky assets, it didn't go to the Australian dollar, it didn't go to gold, it went to the euro. And so people had to start thinking again, something most investors weren't used to. And in fact, one of the biggest problems of this environment is we started out this conference saying that there's lower attendance because people are driven into the stock market. I talk to investment professionals every day. Many of them say we lose clients because we have a conservative allocation. Some of them tell me point blank, even though they disagree with it, they have changed their investment allocation because they were losing clients. They cannot afford not to chase the markets. If in a down market, if you're an investment professional and you lose more than the market, your clients forgive you. If you don't keep up with the averages in a bull market, clients are merciless and leave you, and that kind of fosters some of that herd mentality. Let me just very quickly here touch on a few things that people are doing when they try to get out of bonds. And you can look at this here. I'll just touch on one of them. You might have heard of a San Francisco-based firm, the largest asset manager in the world. I won't mention BlackRock by name, but if you went to their homepage a couple of weeks ago, and I don't go to the homepage often, they might have had it there for longer, they are praising a new class of fixed income products. And they're very successful at selling them. Now, one of the first things you see when you look at the advertisements is MLPs, Master Limited Partnerships. Now, there's nothing wrong with Master Limited Partnerships, but we manage mutual funds. We deal in liquid assets, daily liquidity. You don't have daily liquidity in MLPs. Well, you're allowed to have a tiny sliver of illiquid assets in your mutual fund. They had 1% in that particular fund. And guess what? Once you have that, you can advertise that you have MLPs. So if you dig deeper and actually look at the holdings, the biggest holding is dividend-paying emerging market equity stocks. So that's your new fixed income product that's sold to the professional world. And maybe there's value there, maybe it's a good buy, but to me, that is not a fixed income product. But that is why BlackRock has been raising money, because they have been adjusting to the times, whereas PIMCO, that's actually trying to stick to its guns, has been having major outflows. And of course, the question is, what do you do when you're faced with those sort of things? One of the things that happens in a world where policymakers have to deal with too much debt, and by the way, the main implication and the main takeaway from all of that is that the interests of governments are not aligned with the interests of citizens. When a government has too much debt, they have an interest in debasing the value of that debt. If you are an investor, you have an interest in preserving your purchasing power. So some in this room might think, oh, it would be great to go back to a gold standard. Over the past 100 years, we've gone further and further away from the gold standard. If you want a gold standard, you need your personal gold standard. Don't have your trust that your government is going to take care of it for you. Their interests are not aligned. They have different interests. And the grass isn't greener on the other side of the fence either. Some people say, oh, the Chinese are going to go and back their currency by gold, have an open capital account. Well, I'm very optimistic on China, and they'll hold more gold over time, but they're not going to go to a gold standard because they like to have the same flexibility as everybody else has. Their way of managing their reserves is going to be different. They'll have their custom basket of currencies and a basket reserves that might include forest and real assets. And the Germans will do it differently and the Russians will do it differently. And the dollar is going to play less of a role in that. But there's not going to be a unifying body that says this is the new world reserve currency that competes with the dollar. The dollar has to compete with everything. The reason the dollar is so popular is because the dollar has the greatest liquidity. If you have $1 billion to deploy, treasuries are your only game in town. The other big treasury markets are the Italian and the Japanese treasury markets, and the Japanese market is drying up because the Bank of Japan is buying everything. And so central banks and big investors are looking for ways to diversify. And one big thing that's been happening of late, when the money fled emerging markets, I don't know how many of you know where that money went. When everybody thought they have a free lunch by buying these higher yielding local debt securities in emerging markets, what happened, by the way, is that people forgot the liquidity isn't very high, and when volatility spikes because the Fed starts with a taper talk, everybody tries to run for a small exit. That money didn't go to the US. That money went to where Mr. Draghi promised he'll do wherever it takes. Why not capture some extra yield in Portugal and Italy? And it's one of the key reasons these yields have been going down. The good news, by the way, of that is that this is risk-friendly capital. So what if they lose money? What has happened in the Eurozone is that the tier 1 capital of the banks is no longer exposed to that peripheral debt. And so similarly, hedge funds are now buying Greek bank debt or Greek banks. And if they lose money, well, so what? You don't have that contagion anymore. And the proof of that was Cyprus. Cyprus blew up over that same weekend, or just around that weekend. Spain had a treasury auction where they paid the lowest yield since the early 90s, which means risk is priced locally. That is one of the biggest advantages that the Eurozone has had. The problem what's happening now, this talk of QE in the Eurozone, I can talk about that as well, is that again compresses the risk differentiation, and that creates capital misallocation. But you want to have risk being priced according to the risk profile of borrowers. It's one of the reasons, by the way, we're more positive on China, because China wants to have more competition in the banking system. When you do that, it's not just state-owned enterprises that have access to credit, because they qualify, and the smaller enterprises have to go to loan sharks. No, suddenly you can price credit according to the risk profile of the borrowers. What a novel concept. The Chinese are endorsing it, and we're moving away from it with the zero interest rate policy where everything is free, and that creates many more distortions. Now, what are you going to do about it? Well, what's happening is, because there's too much debt, because there's so many problems, the problems are not going away. The one thing that's reasonably certain in my mind is policymakers will remain very engaged in the markets, come up with new regulations, new taxes, interest rate moves. The problem with that is that asset prices are not reflecting fundamentals. Asset prices are reflecting wherever the next intervention might be. And that makes traditional portfolio diversification very, very difficult, because when you have your traditional portfolio to diversify to different sectors, everything moves in tandem. You print more money, all asset prices move higher. But one day the glass is half empty, and sure enough, we have a crash. Last April, price of gold plunged. Well, who says that can't happen to equities? When all these algorithmic traders, if something is not normal in the market, they'll just take a step back. Well, let's watch what's going to happen. And tell me, people that love to buy the S&P at these values, people buy the S&P because they have to. People buy gold because they believe in it. And so the people holding precious metals are much stronger hands these days than the folks holding equities. And so you've got to keep those dynamics in mind as you see things moving on. Now, obviously, our field is currencies. The nice thing about currencies is you have liquidity, but you have to consider other alternatives as well. Challenges that some of those strategies are difficult to implement when you have a more stressful environment. I'll talk about currencies a little bit more. Let's talk about Janet Yellen. One of the things we try to do, we try to simplify things. Let me just touch on a couple of points here, because Janet Yellen is not the same as Ben Bernanke. Ben Bernanke was an academic, a student of the Great Depression. One of his main views was that when you're faced with a Great Depression type of scenario, with a credit bust, you want to push against that with monetary policy. And if you take away the accommodation too early, the deflationary forces are taking over again. So, and now I'm putting words into his mouth, you want to err firmly on the side of inflation. And if you start raising rates too early, all this good stuff is undone too quickly. And that's, of course, some of what we're seeing right now. Janet Yellen is a little different. This theme is hidden in plain sight. Well, listen to her testimony. Listen to her confirmation hearing. The thing she gets most excited about is bank regulation, the competitive positioning of American and European banks. She doesn't know the number of mortgage-backed securities the Fed holds on its balance sheet. She doesn't know the definition of a full-time employee. Granted, you're on the spotlight and so forth, and there's slightly different definitions and so forth, but that's not where her heart is. Her heart is on the regulatory side. And one of the key things that she's interested in is unemployment. So that's her baby. And what she cares about is while the unemployment rate is generally on the decline, the percentage of long-term unemployed is still way too high. Historically speaking, what economists say is the short-term unemployed are cyclical, the long-term unemployed is more structural, and so if you try to boost employment with monetary policy on the long-term unemployed side, you're going to get inflation. She thinks, no, this is just the economy has been so horrible, manufacturing is coming back into the US, and therefore this is all cyclical. Problem with that is that, yes, manufacturing might be coming back, but we have fully automated plants these days. We need different skills than the skills that we used to have, and so it's going to be a little bit difficult. The one consistent theme that we have throughout the world, throughout the US is, and this comes back here a little bit to what I said earlier about the lack of wage growth. People say, Janet Yellen says, oh, we got no inflation. So this is the average hourly earnings here since 07, no inflation as far as the eye can see. Well, if you look at this chart here, this one is a chart of the weekly. It's a slightly different measure, but what this measures is full-time employees only. And what you see is that this trend is a little bit upward here. And this is in line with all the other things we're seeing. If you are wealthy, if you're well off, if you have a job, you have pricing power, you're doing fine. If you're struggling to make ends meet, if you can get a part-time job only, you have no pricing power. And so if you're at the high end of things, you're doing fine. And so the folks who are well off, they are doing fine. But there is this great dispersion. Now, before you blame politicians for it, I happen to believe that monetary policy has a far greater impact on the wealth gap than the policies of either Republicans or Democrats do. If you have a low interest rate environment, if you know how to deal with credit, you can gear yourself through the nose and do great. But more and more people fall through the cracks that can't deal with it. And then conversely, at the other end of the spectrum, what you see is that if you're lured into debt and you lose your job, then you have a big problem. And so and if interest rates were higher, asset prices might be lower, homes might be more affordable, the dispersion of income might not be as great. And so it's this low interest rate environment that's helping to foster a lot of the instability that we have in the system. One of the biggest problems with a low interest rate environment is that because it is driving asset price inflation, well, asset price inflation can revert in a heartbeat. And by the way, the reason why the Fed is doing a lot of this is because when you have millions of homeowners underwater, they are not very good consumers. Bernanke always argued that you need to have homeowners who are not underwater if you have a consumption-driven economy. The problem is, and we see it here, there are major headwinds, and it's not the weather, that ever since the taper talk started, home sale numbers have been deteriorating, and because there's the anticipation of higher rates down the road. And so coming back to Janet Yellen, coming back to the question that was earlier, we have an incentive baked into the system to have negative real rates. We cannot afford positive real interest rates. Take the Japanese maybe first, because there everybody agrees. If the Japanese, the biggest problem, if you look at the previous chart, and if you read it while I was chatting about something else, the biggest threat out there that I see is economic growth. Now, it's unlikely to happen, but if we do get substantial economic growth, what do you think is going to happen to bond prices? Bond prices are going to plunge, meaning yields are going to rise, the cost of borrowing is going to go up. How can the Japanese finance their deficits if bond prices were to fall? Now, fear not, Bank of Japan is there, and they can keep yields low. Now, I disagree. I think, Chris, you said it a little bit. I think the term you used, I don't know, you used something about keeping, something about a valve or blinking. About blinking, that nobody's going to blink first. There's always a valve. There's always, the money is going to find its way somewhere. The valve that we look at is the currency. If you keep yields artificially low, the currency is going to give. Our price target for the yen is infinity, meaning we think the yen is going to be worthless. The problem is Japan is no Cyprus, which again makes it more likely that policymakers will be actively engaged trying to fix the mess. Of course, by trying to fix it, they'll probably make it worse. So contracts will be renegotiated, has been said once by PIMCO. And I very much agree with that aspect. You want to know where you have to be along that line. Now, if you think that it's only a Japanese problem, look at the projections of the Congressional Budget Office, 10 years out. Right now, we're paying about $200 billion a year to service the debt on marketable securities, government securities in the US. In 10 years, the CBO projects it's about going to be $900 billion. Now, with that, the CBO is still projecting that we will not go back to the historic average cost that we've been paying our interest. If we were to do that, and the CBO thinks that's ridiculous, that's too high, to go back to the average, we would be at $1.2 trillion a year just paying interest expense. We can't afford it. And so with that, there is an incentive baked into the system that we keep interest rates low, which is an incentive to keep real rates in negative territory. It's one of the reasons why we got a little bar of gold there, because it's one of the reasons why we think gold in the long term is going to do just fine. Now, clearly, if gold goes up for 12 years in a row, people shall be excused to take out some leverage to try to gear up, and of course, there has to be some momentum in there. By the way, before I forget, we do publish a newsletter, and if you want to get these cartoons and our newsletter, free newsletter, put your email address down and give them to Heather or to me, and I can put you on that list. Also, somebody mentioned something about a new product we're bringing to market. I can't talk about it, but if you give me your email address, then I can talk about it, and I'm not going to talk about our products otherwise today either, but if there's a gold-related product that I might be able to send you information on if you give us your email address. Now, who is voting in 2014 is the title of this chart, and Chris already referenced the folks on the at the Fed. Every 6 weeks we publish the projection of what are their views and so forth. Well, every 6 weeks they meet. They don't publish the projection every 6 weeks. What matters is who is going to be voting next year if they really are in the stage where they would want to raise rates. And what you see is that you might not be able to read it, but Charlie Evans is voting next year. He's the super dove who always wants to have lower rates. The only hawk is a regional Fed president, Mr. Lacker. And then you see on the, and then obviously under the chairwomanship here of Janet Yellen. Let me just spend a word quickly on Stan Fisher, who is almost certainly going to be the vice chair at the Fed. He is a statesman, has a very good reputation, generally speaking, the mentor of Ben Bernanke. And I heard him speak at Stanford a couple of weeks ago. What he is going to bring to the Fed is consistency and stability. He said that there's an Arab proverb that when the dog barks, the caravan moves on. Now, translate that to what's happening at the Fed here. It means that he's going to tell Janet Yellen, ignore the noise in the market. So whatever your policy is, go on with it. Don't worry about a little bit of inflation here or there if you think that inflation is low. Don't worry about a stock market crash. Don't worry about a bad quarter one GDP report. Just continue doing what you're doing. Now, the problem is, of course, if you look at the 10-year, it has barely moved in recent weeks. And part of it is because the Fed hasn't given any guidance where they're going to. One of the key reasons they haven't given any guidance is because they have no clue. And the reason they have no clue is because they have taken their own gauges away. They're managing the entire yield curve. They're setting long-term and short-term interest rates. And so they're reading the tea leaves like just anybody else. So, of course, it's the weather. It's this or that, and it's all short-term. And with that, it's very difficult to price an asset if you don't have a reference point. And the Fed does have a big influence in pricing assets, and that's why people want to know where it's heading in. I'm running out of time here. Let me just here mention a couple of things. I gave you this chart here on the table, printing presses throughout the world. This is the percentage growth in balance sheet since August 2008 that you have in your chart. This is over the last year. Not all printing presses are created equal. The Federal Reserve is a champ in printing money. The Bank of England is tapering. That is tapering. The Federal Reserve is not tapering. The Bank of Japan is only getting started. On your chart, you see the chart since 2008. They have barely gotten started with their printing press. That's why others are not complaining so much. Look at the European Central Bank. They're not only tapering, they're mopping up liquidity. If you look on your chart, that's the darkish blue line there. It goes up a little bit and then back down. What's different about the European Central Bank and the Federal Reserve is Federal Reserve knows exactly what's right for you. They buy a certain amount of securities. Now they're tapering a certain amount. The ECB is more demand-driven. They provide liquidity. If you want it, you take it. All the banks don't want it anymore. They give it back. Draghi is extremely frustrated with that. And there's Mr. Draghi. In the background is the German Chancellor, who is trying to be convincingly irrational so that the market will buy that he's going to create inflation. The problem is he can't. It's very difficult for the ECB. Structurally, it's very, very difficult to do. And let me just show you here. First of all, these are the Spanish yields. Spain now pays less than the US on 5-year notes, less than Canada as well. That was at least 2 days ago. I didn't check now today whether that's still the case. Much of that is because he'll do whatever it takes. The money fleeing Russia, fleeing those sort of emerging markets. So there is already a tremendous stimulus in these economies. You don't need lower rates. This is already too low for these countries. We are where these problems created. This one here, the blue line, the darkish one, is the deposit facility at the European Central Bank. The reason that's relevant is because the next big threat the ECB has, they're going to make the interest rates, the deposit rate negative on the deposit facility at the ECB. It's close to zero. It doesn't matter whether it's negative or not. The thing that this is going to do is going to create headlines in Germany and Northern Europe that first they took away the Deutschmark, now they're stealing our money outright. The deposit rates on savings accounts are not going to go negative yet. That's why the market isn't buying it. And then secondly, as rightfully said, a US.QE program doesn't make sense in Europe because people don't, the credit markets work differently. People take loans from banks. The banks are impaired. Well, the way you fix it is not with QE. The way you fix it, you do a stress test, you identify the weaknesses, and then unlike Trichet, what you got to do is you actually have to have a solution to for these banks. Now, what he wants to do is he wants to have some asset-backed securities program. It's a good idea in principle, but you can't just get that up and running overnight. If that were the case, the folks at Goldman Sachs would have already done that. They don't need Draghi for that. And so he's pushing them in that direction. In the meantime, he can talk. And because he's talking, the yields are coming down. If and when he were to implement it, the impact is probably going to be rather negligible. And so in the meantime, he wants to sound crazy and convince the markets that he's going to get up inflation because politically, it's extremely painful to request that folks take lower wages. It's so much easier to deal with a debt burden if you can inflate your way away. But the US and the Japanese are going to be way ahead of the Eurozone. Now, clearly, if inflation is induced by those guys, the Europeans are also going to get some. And by the way, if Russia turns off the gas for the Eurozone or for the EU, well, that's going to get inflation. And the energy prices are factored in the ECB monetary policy. So let me just here quickly a word about what we do. We do fundamental analysis on a macro level. We put ourselves in the shoes of policymakers, as painful as it is, because we think that's what's driving asset prices these days. We publish a great deal. One of the things we do differently, and one of the reasons you hear us a lot in the media, is we engage the public in discussions and debates. The reason we do that is not just because we love the marketing that comes with it, but more importantly, that we get feedback. When we published a piece called Draghi's Genius in August 2012, we told folks, we got a lot of feedback. None of it was positive, but it helps us to check our theories. It helps us in our idea generation. And so one of the biggest fears with any investors is that you're too narrow-minded in what you want to do. Let me just mention two more things here. One of the things that is very popular right now is to buy the Nikkei but hedge out the currency risk. Last year you had gangbuster returns. This year it didn't work. About 40% of equity returns, international equity returns, are due to currency. And that's both on the upside and the downside. If you hedge that out, you might be okay on the. Oops, sorry about that. You might be okay on the yen, maybe a little bit on the Swiss franc, but you're certainly not okay on any other currency. You got to actively manage your currency risk. And then just one more word. When you look at currencies, there are two things you can do about it. You can look at the dollar versus the euro, a basket of currencies, or in case of a mutual fund, a managed basket of currencies. You get a risk profile like the dollar index, annualized standard deviation around the 10% level. That's more than bonds, less than stocks. But you can also look at it in a non-directional way. Now that gets a little technical, but think about taking a position of the Australian dollar versus the New Zealand dollar. What you can do with that is if you think that one currency is going to outperform the other one and you buy one, you sell the other one, the returns you generate are almost certainly not correlated with anything else you held in your portfolio. And the power of that is that if and when your portfolio does tank on the equity side, you have somewhere where you can seek refuge, especially if you don't like bonds. And you're offsetting the risk profile of one currency with that of another one. So the resulting, if you don't use leverage, assuming that, the resulting return stream you get is only slightly more volatile than your typical bond fund. Correlation, by the way, between currencies, the two last indices are currency indices to bond indices are very low, near zero. And that's about it. Some disclosure here as well. So I'll be later on the panel after the movie we are viewing. And I don't know, I probably talked longer than I should.
No, that's fine. Actually, we have time for a few questions while we set up the movie as well. So go ahead. You'll lose your slides, but
go ahead.
Mike?
Can you talk a little bit about leverage of U.S. banks versus European banks and maybe even China, if you have something on that?
So leverage of U.S. banks versus European banks.
Sure. Clearly, the European banks are much more levered because they're structured very differently. They work very differently. Capital markets are not very well developed in Europe, even though it's a developed world. And without going into too much detail, I just mention a few things. Central banks in general, if there were to be another crisis or when there will be another crisis, can keep a zombie banking system alive. They've shown in the US in 08. They showed in the Eurozone debt crisis. They cannot provide solvency, but they can provide liquidity. And we know the game plan when there's a problem. So that's all I mention right now in the interest of time. But I do mention a thing about China. I mentioned already that I'm positive about the changes that are happening with the allocation of credit. The one thing I like to mention of China is if a housing bust does occur, or when it occurs, there will be lots of municipalities, lots of banks that will have a problem. But because of the centralized nature in China, these are comparatively easy to deal with. The one thing that people are underestimating is that consumers are going to be far better off in a housing bust than many people anticipate, because people don't borrow money to buy homes. The Chinese don't know what to do with the money, so they stuff it into housing. And that's very different from a housing bust in the US or in Spain, for example. And one of the reasons why I think China is going to be better off than many others is that if you look at numbers coming out of Australia, they're much better than expected. The Australians are exporting a great deal to China. The Chinese trade numbers are very difficult to read these days. They've been plunging, but they've been plunging because people have been playing arbitrage games between offshore and onshore renminbi. These are technically the same currencies, but they're capital controls. So if you disguise something, a currency trade, as a trade in real goods, then you can do it. And obviously, smart kids have learned to gear themselves up, do these on a levered basis. And then last November, the State Administration of Foreign Exchange announced that they'll introduce volatility into the exchange rate. They did it. Everybody was screaming. Well, volatility is the enemy of leverage. And you said you don't know how a bubble bursts. Well, a bubble usually is on the backdrop of complacency. S&P going up, VIX index going down. That's bubble territory. Difficult to time when that turns, but when volatility goes up, a prudent, rational player will delever. So similarly, in the case of China, the CNY, CNH game, onshore, offshore currency, what happened is people had to give up that game, and that, of course, creates certain hiccups and so forth. The good news is that now people can do real hedging. So I know I didn't fully answer the question, but I just wanted to be a little bit thought-provoking in addressing it. Have time for another one?
Yeah. Can you talk about what happened to the yen this year and why it's as strong as it is?
The Japanese yen?
Japanese yen.
Well, I mean, it's first of all, I don't think it's very strong, but when everybody piles into the same trade, clearly things are not a one-way street. And one of the things we're watching very carefully is the correlation, for example, between the yen and the VIX index. And that's the S&P volatility index, to see whether the yen is giving up its status as a safe haven. That correlation used to be very high, and then it deteriorated, and it deteriorated as a lot of abenomics was coming into play. Now, in the last 9 to 12 months, that correlation has been increasing again. The main thing that suggests is that abenomics is not very effective, that people think that everything is going to go back to the old ways. But there's one key thing that has changed. The current account surplus has eroded in Japan. when you have a current account surplus, then a shock to your economy, an earthquake, is a good thing for the currency. In 2011, when the earthquake happened, the yen went up. A couple of weeks later, Christchurch in New Zealand had an earthquake. The New Zealand dollar plunged. They have a current account deficit. Now we have a current account deficit. The difference is now you're vulnerable. Now, how vulnerable you are? Well, it's still a comparatively small current account deficit. And so this is a little bit like a canary in a coal mine, but in the meantime, of course, everybody piles into this trade. One of the main things that's been happening in the currency markets, the volatility has also been going down. It's not just in the S&P. Volatility in exchange rate has gone down. Part of it may be because everybody loves buying these currency hedge products these days, but a lot of that will then in turn, again, encourage people to use leverage. To me, what's going to happen is that the Japanese are not going to be effective. And by the way, the reason they're not effective is that when you debase your currency, you are doing a disservice to your country because you're providing a disincentive to reinvent yourself. The Europeans with that strong currency, they have to compete on value. They cannot compete on price. And if you push the currency lower, you're not going to restructure. You're not going to reinvent the wheel or reinvent yourself to do things. And so similarly, the Japanese are not making any progress. And so the question is Abe going to say to the Prime Minister, oh, I'm going to disappear? Or is he going to double down? My view is he's going to double down. In the meantime, the cheapest monetary policy is one where you're talking, where you just say, hey, we're going to get inflation. We're going to do this. And so right now, Kuroda, head of Bank Japan, thinks, oh, maybe I can just talk these guys into thinking we're going to get inflation, and that's going to kickstart the economy. The one thing that Abe has done is he's changed the mindset that people are actually quite positive. The early stages of inflation feel very good. And so that's kind of the phase that we are in. The problem is that there are lots of things that can go wrong in the exit. And if I can just make one more comment here, it doesn't really matter how things will kind of play out. The question is, when you make an investment decision, or when I make one at least, my view is you got to plan about what are the risks that something could go wrong. Are certain scenarios possible? And if you think that there's a non-negligible chance, and if the impact can't be significant, well, then you should take it into account in your portfolio allocation. And more importantly, if you manage money on behalf of somebody else, I think it's your fiduciary duty that you should be taking into account in your portfolio allocation. Much of that is not happening. And so it's and my view is that just as Bernanke had his toolbox, every investor should have their own toolbox to try to take advantage of some of those things.
Great, thank you. Axel said that volatility is the enemy of leverage, and I thought that was so good. I tweeted it, and I used a hashtag WCC 2014, and if you don't know what that means, don't worry about it. But if you do, then you can do the same on Twitter.
And by the way, regarding Twitter, if I can do one more comment, a lot of time I get the question, what news should I follow and so forth. Now, of course, you should follow Chris Martinson and read his newsletter. But other than that, whenever you read an article of somebody that you like, and wherever that is, if it's Financial Times, Wall Street Journal, or something like that, look up the author and follow that person on Twitter. That's the best way to kind of comprise your own journal of where you want to be and what you want to follow. Because a lot of these influencers are on Twitter these days, and that is how you can see. That is where breaking news is. Journalists love following folks like me because we give instantaneous interpretation of the news. So follow me on Twitter, follow JJ, follow Chris Martinson, follow anybody who's speaking here to the extent they have Twitter accounts.
Mine's pretty boring, but great. Well, thank you, Axel. So what we're going to do here is we're going to get the movie started. We're showing a condensed version of Money for Nothing. This is about a 55-minute version or so, 60. And we're going to play that out, and then we're going to have a panel discussion about the movie with some of our speakers and with our director of the movie, Jim Bruce, who is here and just plugged us in. So we'll watch it, then we'll talk about it.